Welcome to this video day, which is all about Forex money management and risk control. Now, in terms of today's tutorial, what we're going to be doing is looking at some money management rules that if you use them, they will not only help you restrict drawdown and periods of losses on your account, they'll also help you maximize profits. Now, in terms of the rules themselves, I've divided them into two groups. The first are rules for setting and managing your stop losses, and then the second set are for managing your overall account equity. Now, in terms of most traders who come into the markets, they tend to focus purely on their entry. They think getting the best entry price is going to make them profits, and they neglect their stop losses, i.e. they don't put enough thought into them, they don't have set rules, they're kind of placed as an afterthought. My own view is, sure, the entry price is important, but the stop loss is just as important. In fact, I think it's more important. Not only does it have to give you good protection, it's also got to be placed and moved in such a way that you can ride big profitable moves. Now, in terms of the rules themselves, what I'm going to do is I'm going to give the first batch of rules now. They're going to be coming up on the screen. Some of them don't need any explanation in my view. Some of them need a little bit more explanation. So let me just show you the rules, and then I'll be back in a few minutes to discuss. I'll come back up that short summary. I'm just going to go through some of the points in a little bit more detail. In terms of overall account exposure, you should know that every day. How much are you going to lose if all your open positions go wrong at once? Now, a lot of traders think they're trading uncorrelated pairs. That isn't going to happen to them. A lot of traders don't even think about it at all. Trust me, if you trade for long enough, all your open positions will go wrong at once. So keep the risk below 10%. When you're determining your trade size, that is done by your entry to stop loss. So if you're risking 200 pips to your stop, your trade size is probably going to be a half of a trade where you're only risking 100 pips from entry to stop. Most traders, they basically do too big a position size, and they then look to do a stop loss, which is monetary. Basically it's within their pain threshold, and they place it too close. They then end up getting stopped out the market. Then the price reverses and goes the way they thought, and they're not in. Now, when you've got your stop losses in the market each day, you should review them. You should review your trades and decide whether you're going to keep that trade open or whether you're going to move the stop up. And one thing I'd say about moving stops is don't move them for the sake of moving them. Some traders get so excited when they've got a profit. They either want to put their stop to break even as quickly as possible or right behind the entry price, which is within the noise. You've got to be sensible with the way you move your stops. They must always be behind, in my view, a significant level of support or resistance. Now, in terms of stop losses, I'm a big fan of timed stop losses. I'll give you an example, breakouts. If you're expecting a big breakout through a very significant level, it should follow through to the upside on the day. What you want to do is see a big bar up or down and a close near the high in an uptrend and low in a downtrend. If you don't see that momentum as you're coming through the level, chances are that breakout could fail. So basically only give it a day. If it doesn't finish strongly for you, you just basically take the trade out the market. In terms of contrary trades, I do the same sort of thing. I'll probably give it a couple of days on a contrary trade normally. They should reverse for you quickly. Okay, you should start to see weakness within a couple of days. Obviously, if the trade doesn't weaken as much as you thought, or strengthen if it's in a bear market or downtrend, then just simply take the trade out the market. Now, in terms of actually placing the stops, you've got to think about obviously not just protecting yourself, okay, but also placing your stop so you are not with other traders. To give you an example, you should always have a stop down an important level of support resistance. I've just said that earlier, and you'll very often find those levels might be round numbers. Now, don't place your stop, let's say 2 or 3 pips behind the round number. There's always noise around them, and you want to keep your stop back 30, 35 pips. So you're out the way of the novice traders who cluster around those levels. And I've seen it as a broker. They do that. They continually get picked off on stop. They blame their broker. It's not their broker. Basically, they put their stop in an obvious level. The market takes it. Then it reverses and goes back the other way. I've seen that so many times. And in terms of placing stops in noise, what I mean by that is, you see a lot of people saying trade with 20 pip stops or 30 pip stops. No, you can't. You can't do that consistently at all. Most currencies are moving 100 pips a day. You've got to be behind a significant level of support or resistance, and that's normally 50, 100 pips plus. Okay. Now, in terms of your trades in the market, if you have got a trade it isn't doing much and you see a better opportunity elsewhere, even if you've got a small loss, my view is to stop yourself out of your existing trade and go to the better opportunity. I don't see Forex as like you're trading individual trades. You're actually trading the market, so you want to be in the best odds setups. So I see nothing wrong with doing that. In terms of a lot of traders won't do it, but I think if you get used to doing it, you will substantially increase your profit potential. Now, in terms of stop losses, that is only part of risk control and money management on a Forex account. I think you've also got to look at your overall account management as well. Just want to give you some rules which I think will help you control risk on your overall account. I'm just going to be putting them up on the screen for a few minutes, and I'll come back and discuss them in a little bit more detail as well. Be back in a moment. I'll come back after that short summary there. I just want to go through some of the points in a little bit more detail. In terms of beginners, I think a fatal error that they make as soon as they've made some money in the markets, they are keen to increase their trade size. This is very psychological. They feel that if they lose the money back that they've made, it's not as important as losing their core equity. Now, if you approach the markets with that sort of view, you're going to give back the money. You're going to take too much risk or too much leverage. Your money is going to go back to the market. For me, money is money, be it your core equity or profits you've made. You've got to look after your cash. Now, in terms of drawdowns, 20% drawdown is normal for me. When I get to 20%, I like to cut back trade size, be patient, and just get off the drawdown. Now, I know that coming back from a drawdown requires patience. I think anyone who's traded for a reasonable period of time realizes this. But I find that if you look at beginners, they don't decrease trade size. They've lost money. They actually increase it, and they also start to take more trades. They're in too much of a hurry to get the money back. What happens? They just dig themselves a bigger hole. So always be patient when you're in a drawdown period. In terms of how many trades should you have open in the market, I put down 4 on that summary sheet, maybe 6. I don't think you need any more than that at all. I see traders who have like 20 trades in the market. They think that they're diversifying. So basically going to reduce their risk by having so many pairs and also increase their profit potential. Diversification does not reduce risk and actually dilutes profit potential. Why have trades that are not optimal or the best in your account just for the sake of it? I think you should only focus on a few pairs, and I couldn't agree more with Warren Buffett's comment there. In terms of having a target growth, I think you should have a target growth per annum, which will be in relation to your risk tolerance, and if it's realistic, it can be any amount. I've put down 100% for the sake of an example, but I don't think having 100% growth or target growth per annum, working towards that is easy for anyone. You need to break it down into a shorter term time scale. I think it should be done quarterly. It'll keep you very focused on what you need to achieve if you do that. Now, in terms of windfall profits, over the years, I've had big open profits. I think they're going to get bigger. They suddenly just disappear. And I think when you've got a windfall profit, and it can be a percentage you set against your account, as soon as it is hit, just take it in and have a couple of days rest. I'm all for just banking windfall profits. Right, that is the video for today. I hope you enjoyed it. I mean, the stop loss rules I've been using for years, and I always think it's a great idea to manage your overall account equity as well. I think those rules that I've just given you will help keep you on course, hopefully. But no, in terms of risk control, it's the most important part of Forex trading. You've got to have good money management, and I hope you found the rules that I've laid out today useful. Thanks for watching me as usual. Take care. Have a good day.